Welcome to Trillium Wealth Plain Talk. I'm Steve Laska, managing partner at Trillium Wealth, and I'm here as usual with Matt Gomoll, who's both an advisor and the head of our investment team. So, Matt, we thought we'd stop talking about the war a couple ago, and then we had to talk about it again. And I'm guessing that you're going to want to talk about it again today.
Yeah, we actually came prepared to talk more focus on credit markets and how they're responding, and a little less on the war. However, we're recording this on Tuesday, March 31st, and there was a big move in the market due to conversations around what's happening. It was, I think the S&P finished just below 3% up. NASDAQ was almost 4. I think it was 3.9% up on the day. And it was all due to statements made about, hey, we're going to end this war, from the Trump administration, showing signs that we're not going to escalate to ground war, and we're going to instead back off. And there's some indications that Iranian leaders are open to talking now. So all that kind of development was enough to send equity markets higher, as we kind of price in that this will last shorter rather than longer.
You know, it's interesting. You and I had a talk about this recently, and I keep saying that the news doesn't know how to report the news anymore. What I do find interesting is the markets in general seem to understand the signals better. I think you and I, when talking privately, I said, geez, if you turn on the news, if the current administration says something and Iran disagrees, somehow the news is telling us that we're lying and the Iranians are being very honest. It does seem like the markets are picking up the signals pretty clear. I mean, I think they take a much more pragmatic approach, much more logical approach. And the signals out of the administration were pretty clear today that we're absolutely not going to stretch this out. Now that could change tomorrow, but they seem to put a stake in the ground today. And I think that's what the markets are reacting to. Like, hey, it might take a week, it might take 2 weeks, but we're not doing an Afghanistan here.
Yeah, and this is the tricky thing with, is it Trump reacting to markets and pressure he feels and political pressure that emanates from economic pressure, or is it him saying stuff to manipulate markets to get them to buy him time to do what he wants? It's a confusing feedback loop, and you're not sure which came first. But yes, so we might go through another period of language that de-escalates, but then actions that re-escalate. But he bought himself time with the markets, and then after the escalation of action, come back with more de-escalation language, and we'll see how that plays out. We're kind of just watching it and seeing where it goes. But there has been a pattern of this, like escalate to the point where you can stand it, and then back off from there. That's happened multiple times, in the last year and a half.
Yeah, I do feel like, I guess sometimes I like to be right. Like a month ago, I said, this guy will just declare victory when he wants to declare victory. And candidly, it's not a bad time to declare victory. Like, as you and I've talked about, like however long these things can get stretched out forever. But from a military standpoint, he's not wrong. From a military standpoint, it has been decimated. Like that part, it is what it is, right? And I do think, for better or for worse, and maybe in this case for our clients, for our economy and all those things, for better, the overhang of midterms coming up, the overhang of the CPAC conference being, was it yesterday or last week or whatever, and the president not speaking there, and it was like, well, he's busy. He was playing golf. He wasn't that busy, right? He spoke there for the last decade, right? His family members weren't speaking there. That's a very conservative group that also doesn't want war, right? They just in general don't want it, no matter what happens. It was interesting. I was watching Warren Buffett today on CNBC, and in his kind of style, he seemed to kind of endorse the fact that this was a problem that needed to be taken care of, and he's pushing 100, so he's been around quite a long time. So he's never real forceful on politics, but seemed to intimate that it was something that needed to be done. So let's talk about now the effect for our clients, because there was a lot of things going on in a very short amount of time that people didn't realize. So mortgage rates, they bumped up pretty substantially during this month. Like they just kind of they bumped up,
Yeah,
and
they
even
were up almost 0.5%
yeah,
from
that's a lot.
what it was coming into March to
Right.
today was almost up 0.5%. Now it's come down a little bit, basically Monday and Tuesday, as there's been some better signs there. But yeah,
And we did have Chairman Powell on the Fed. Probably good messaging. Although I'm a fan of rates coming down in general. At least saying that, hey, the Fed's not going to react to the oil prices and say that inflationary pressure is going to make us raise rates. So he did at least come out. I think that was today, and say, or maybe it was yesterday. We're not going to. The Fed's not going to come up and raise rates based on inflation. That's based on war and oil prices. So that was a good thing. But what are you seeing out there in general, again, for our clients and what it means to their portfolios?
yeah, the oil market was kind of moving everything, and so because there's so many downstream products of oil, right? Yeah, it goes in the gas tank, but it also has a lot of byproducts and other refined products that come out of it, and those trickle through the economy and have inflationary pressure. So it was so the oil market was moving things. The bond market reacts, saying number one, like I don't think we're getting any cuts, because we feel like all these other pressures on pricing are going to take a while to work themselves out. Now, even if the straits were open tomorrow, there's still some amount of we had high oil prices for a month. So there's going to be like lasting effects as those oil prices get distributed downstream to other products. Um, but if it only lasted a month, it's short lived and it can work its way out of the system. So, but all that kind of back to the, Chairman Powell saying, well, we're not raising rates due to inflation scares, but we're also probably not going to lower rates. And so we think there might be one rate cut. Um, is that kind of political in the new chairman trying to get one win on the book? But there's probably not much justification or support for it among the board to get more than that. So bonds are looking through that and saying, well, we're kind of where we're at. And now we have a little bit of inflation scare and a little bit of growth scare, right? As inflation kind of eats into growth. So that caused, like we said, the 10-year went up about 0.5% from start of March till Friday. It's come down a little bit since then. Mortgage rates right along with it. They're moving up throughout March, coming down a little bit since then. And it just it's one of those things that while we hoped we were going to have some relief on, housing affordability this year with lower rates, yeah, it's lower than when rates were 8, but they're still in the, mid to low sixes. We're not back to, 5% rates. So that's kind of stuck there probably for most of the rest of the year.
Well, since I brought up the Oracle of Omaha, I forget, it's a big number. It might even be bigger than I'm saying. He bought 17 billion worth of treasuries, I think, which means he thinks the rates are going to go down. Right. He thinks he's buying about a peak right now. And that's again, if you're going to look at anybody and go, he
Yep.
usually has his finger on the pulse of it. It was an enormous amount, and maybe not in the grand scheme of Berkshire, but it's still it's enough that it was a headline and that he went out and bought them.
Yeah, it's not a bad place to sit. I mean, for folks who need income, locking in at, in the 4 to 5 range on treasuries, not bad, right? And like you said, are we going to be there 2 or 3 years from now? No, probably not. Like rates probably are lower in a few years. So locking those in now, not a bad move for kind of guaranteeing that income.
Yeah, and, again, there was a country we don't want to borrow money at that rate, and we're pretty voracious borrowers still.
Oh yeah. Yeah, and that's the thing. Like, there's until politics changes, nobody is incentivized to spend less money. All the politicians are just going to keep spending more money. So that is certainly a problem, and that we've seen that over the last few years of credit markets wanting a little more premium on what they get on U.S. Treasuries, because saying, "Gosh, this is going to be hard for you to pay this 30-year back, that I'm buying at whatever rate," and so there is a little concern. One thing that's been really interesting through this process is the oil price shock affects countries differently, and there's actually some winners and losers, and that trickles down to there are some emerging market bonds in other South American countries that have a closer source of oil and might do okay. That was an interesting podcast I was listening to last week on the topic, just saying the Venezuela kind of regime, maybe not change, but rebrand, and getting opened their markets up. They can produce more oil. Their bonds became a lot more safe than they were prior to that operation happening. And other South American countries are going to benefit from more oil being produced in this hemisphere, while other folks, picture Asia, are going to be suffering from higher oil prices. And so this Straits of Hormuz closure has really put a lot of pressure on Europe and Asian countries, and certainly less on the U.S. But also South America is going to be okay.
So, something you and I talked about with, one of our other partners today is kind of how some of those movements are working. And like, I do go back further than everybody, right? So we were talking about going back way back when there was a real stick to itiveness that changed behavior. So if you go to when the tech bubble happened, and certainly even before that, you had these long drawdowns, these precipitous drawdowns, and it changed behavior so that anytime something went wrong for a while, investors panicked and they're like, man, here we go again. We have the opposite of that for the last 15 plus years. Like, for the most part, we get asked, like, how are your clients reacting? Like, we're not getting lots of calls on it, because at the end of the day, for the last 15 years, what people have seen is sharp drop, immediate turn back. Like, there's no protracted bear markets in the last 10 or 15 years. And what I'm surprised at, so even Buffett, with all the money he has, and I gave a big number on what he's buying at treasuries, there hasn't even been necessarily a flight as rates have gone up. Normally there's a flight out of the equity markets and into those. Like, you got, I mean, I think the 30 years up around 5 now or something. Like, you have some stuff out there where you can really kind of lock in some pretty high rates. And we're not seeing that either. We're seeing market resilience, and we're seeing investors stay in growth, stay in the market. Same for what our investors may or may not realize is historically value stocks, which is a Buffett thing. By definition, for people out there, a value stock means I'm buying it at a good value. It's underpriced. And long term, those things always outperformed. In the short term, growthy stocks outperformed. But growth still is, even if as value has some of these like little windows where it's still doing well, growth's still there. There's not a flight from the market to credit. Do you see that continuing?
Yeah, I think investors. And you got to kind of picture there are wealth management clients who have a partner they can talk with and work through a difficult time. There's retail investors who are just doing their own thing, maybe on a Robinhood app. There are institutional investors managing endowments and all these things. Each group kind of acts a little different. But those people who are really active in trading and making moves and going all in and going all out, they've gotten burned by this whipsaw effect of sharp down, sharp up. I missed, I sold on the way down, and the upside happened so fast that I didn't get back in. And so you do that a couple of times, and I think people have learned, like, okay, I think there's going to be some changes here. Let's just stay invested, maybe trim, right? So less of the all out, all in, and more of the, I need to trim my risk a little bit as the war started. and let's see how things go in a few weeks. I think that's kind of, um, you see a day like this up almost 4%, you're punished for being out. You can really miss out on some stuff.
Well, that behavior, I think, has been great because it has had people be more patient, right? So I'm glad that there's this kind of psychosomatic overlay. Uh, Going way back, you and I acquired a very small firm, and those clients are still clients, but not many clients. But if you remember, that guy kept talking about even
Yep.
8 or 9 years ago, he had been out of the market for 5 or 6 years and kept saying my algorithm's right and somebody kicked the cord and they're manipulating markets. And I don't know if he would be back in today the way his mindset was. And it's more than double, since then. So I do like, and I encourage people like to keep that kind of mindset. Like there, again, you and I've had some conversations with people even today where we talked about how investors have to know, like, at some level, I mean, I don't want to make it sound like gambling or anything like that, but they're a little bit playing with house money because it's been such a good run up that it's really not a problem with being a little patient now. So when they see these downturns and they see it's triggered by kind of a world event that people have the ability to look at, and there are people in power that can say, how long does this thing get stretched out, right? Um, we we always do hope we learn from past mistakes. Now I say that, and then again in Afghanistan, we not only didn't learn from our own mistakes, we didn't learn from Russia's mistakes. But I think there is a better mindset geopolitically with everybody now of developed countries not wanting to get in protracted things because the outcome on the other side is so devastating to their citizenship. So while we talked about those things, when we talked to touch a little bit on oil. um, the news that came out sent the markets up. Not so much with oil prices yet. And again, reminder to everybody, like, oil prices are based on futures contracts. So at the end of the day, like, if the war ended tomorrow, your gas prices don't go down the next day. Contrary to what Carolyn Levitt, the press secretary, says, it doesn't come down that fast because those things have been purchased at an inflated price. Um, but right now, we may see some things happen very positively here. Gas may or may not come down, even if we say the war's over, depending on what happens there. And it will cause issues in Europe because that's where they're getting their stuff, and that still will affect us a little bit.
Yeah, it's just, going back to the idea that it's a global oil market. And if you're an oil producer, you want to sell your barrel at the highest rate possible. Now, there's shipping costs, right? So that is where we do get a dislocation of um, our oil here in the U.S. that we produce, which might be the West Texas WTI. It might be cheaper because there's a shipping cost implied in there. And, if somebody wants to buy it over in Asia, well, they got to ship it all the way there. And that's going to make the price per barrel go up. And so we are benefiting from producing a lot here. But if our price was too far off, right, then the buyer who's willing to pay, 120 a barrel is going to buy it from us, right? And so then that's one less barrel we have here because it got consumed internationally. So we're at this weird phase where the oil shock has been short enough that we've been insulated, and a price dislocation between our costs and Europe's costs and Asia's costs hasn't spread too much. If it goes on much longer, if we were on month 3 of this problem of the Straits of Hormuz being shut down, I think we'd feel a bit more of it, and just kind of like our prices would get dragged higher as it is everybody else's are too. So yeah, it's an interesting period we're in. We've talked about this before. War is a contest of wills, and also lesson learned from Afghanistan and Iraq is clearly define your strategic objectives and pursue them. So if whatever's been done to the regime, nuclear program, missiles, has been sufficient and we've achieved our military objective, okay, cool. That maybe that is the time to say the Straits of Hormuz is not our problem, and us just stopping fighting will inherently reopen it. I don't love if this thing ends with Iran de facto, having control of the straits and being able to shut it down whenever they feel like, and being able to, bomb their neighbors whenever they feel like. It's not a great situation for the Middle East in general, but if we don't view it in our interest to pursue it to the extent required, which, might be ground troops taking over certain areas to secure that, then that is what it is. We have to go up to the point where our will allows.
There was a report that came out today, by the way, that apparently behind closed doors, all of the Middle East countries were politicking with Trump to fight the fight till the end. Like literally they were behind closed doors. Like all those Middle Eastern countries were asking the United States to stay, make it stronger. So we'll have some political things on those sides. I feel like I do have to remind people, like, they think about gas prices, but our grid is by and large run on fossil fuels. And we're using lots of electricity now with data centers and AI and electric cars like I drive, even though it's cheaper because it kind of converts it to electricity. It's still that. And we have a major heat wave swinging through the West Coast now, right? Even before summer comes. So, but I am cautiously optimistic that we'll get it solved. And I actually, I choose to believe, I choose to believe our administration when they say the other groups are, that they are negotiating, right? Like they do want. I mean, there's just human nature. It does. You can't stand there. You can't sit there and have your country not have internet, electricity, food, and say that we're going to do this for the next 5 or 6 years either. So I am optimistic about that. Anything else in your mind today, Matt?
Yeah, I think what we'll be watching over the next week or two is just, is this the we've defined the trend and we are now on it of we're going to resolution. From the start of this thing, the administration was telegraphing it was a 4, 6, 8 week. It was a limited scope, not a 5-year event, limited. And so markets kind of really reacted as if, oh no, this might be a longer duration than they're saying. If it ends up being that it's over in April, I think there will be lasting effects as the oil prices trickle out through the economy, but then that'll be settled down. I think what'll be interesting to watch is where like energy security goes from here. I think we realize, hey, we want to make sure we have plenty of energy security, and if 20% of the world's oil gets cut off, we're still fine. I think a lot of countries in Europe are feeling the same way. There's been some bad blood, I think, between European allies and the administration right now over them not supporting, them not participating, them not allowing, use of bases, overflight, stuff like that. And that kind of goes in the direction of European defense is going to be on its own, I think, for the next few years, which means they're going to have to spend a lot of money on it and stand up, which is, last year, Europe did really well. As they announced we got to spend money, I was a little cautious about whether they could sustain that politically, and now I think they will. I think this is kind of push them in that direction of they're going to have to spend their own money. So yeah, that's interesting. That creates an opportunity. While high energy prices are bad for them, they're going to be spending a lot of government money into their infrastructure and manufacturing sectors over the next few years.
So before we close out, because this just hit me as you were saying that, for our clients out there, right? When they fear, when they turn on the news and watch troops being deployed there, right size this for our clients. Like the amount of troops that we're sending over there, it's not a division, right? If you look at the size of our military, like this is not it's not a huge commitment. If you sent the Marines to Carg Island that they talked about, and you sent the 82nd where they were talking about, right size that for our clients. I've heard numbers around 1,000 or 1,500. Like put that in perspective for people, so that our folks understand that that's not a commitment to some major ground war like in other wars.
No, it's not. You know, I can't, off the top of my head, I can't remember how many ground troops we had in the region for Gulf War, and then I think the build up to uh, the Iraq War in 2003 was in the 150,000 range. Right now, we're talking about like 5 to 10,000 troops being in the area,
Right.
and this just has, like, we have a lot of troops who are just always in the Middle East. That is a thing, right? Like, we have a lot of bases. We have a lot of people who are stationed over there permanently or rotate through there. So our headcount in the region might be in the 30 or 40,000 range. And now we're adding 10,000. It's like a couple thousand Marines are sailing from Asia over this direction. They're in the Indian Ocean right now. They are very much an expeditionary, short duration, limited objective kind of task force. And we have special operations forces who are much, much smaller and have more limited roles and more surgical roles. And we have the 82nd Airborne has a immediate reaction force where, again, it's maybe a brigade, it's a couple thousand troops. So all of these things are either to create pressure and signal seriousness of intent, right? It's to say, hey, we've got people here. We will retake the Straits of Hormuz and defend it, or we'll take Karg Island, or we're going to go grab nuclear material out of this mountain. Like, those are all limited objectives. These are not, we're going to seize Tehran. That's totally different. That is not a ground invasion force. It is we're trying to apply a pressure. We need a few thousand troops to secure a zone. And so this is what it's for. So yeah, very, very different. This is not, anybody who thinks that this is just how it starts to get bogged down. No. We were fully committed to going into Iraq and Afghanistan with a full out invasion and then
Right.
overstate. Totally different mechanism of getting there.
Great. So, with that, we'll maybe we'll get into. I hope we get into some other stuff on the next one. To be honest with you, because I want it to be over for a lot of reasons. I don't want U.S. people in danger, and I don't want Iranian people to be in danger either, or anybody in the Middle East as they're doing those things. So, we'll hope for the best. So we'll see you again in a couple of weeks. Click subscribe. Send us any questions you have. We'd love to get feedback from you. We'd love to get some ideas of things that you want us to talk about. And we'll see you again in a couple of weeks. Thanks, Matt.
Sounds good.